So you want to be a day trader, but you don't have a lot of money. In this video, I'm going to show you the top 2 options for small day trade accounts and the best strategy you can use to trade that account. Coming up. Hi traders, Douglas here, and we are going to get into the best way to trade a small account. But first, I need you to punch that like button. Okay. The first option you have to day trade a small account is relatively new, but is growing in popularity, and that is micro futures. Micro futures are a fraction of the value of more traditional futures. Let's take the E-mini S&P as an example. Every tick in the E-mini futures is $12.50, which makes every point worth $50. That can add up quickly, especially when the market has been as volatile as it has been lately. But micro futures are valued 10 times less. That means every tick is worth only $1.25, which makes every point $5. Furthermore, the margins are much lower to open and keep your account open. Depending on the broker margins for the traditional E-mini S&P are about $500. And to realistically trade that account, you'll need an initial deposit of at least $2,000. Probably more if you want some wiggle room. I'm just giving you the bare minimum. However, with the micro E-mini, you only need a fraction of that money. For example, to open a micro futures account with NinjaTrader Brokerage, you only need an initial deposit of $400, and your margin, get this, is only $40. Compare that to the $500 margin we talked about earlier. There are some downsides. Micro futures don't have as many instruments to choose from, and of the ones you can choose, the micro E-mini S&P is by far the most liquid, which is why we focused on that instrument today. Also, commissions are low in micros, but they are still a greater percentage of the per tick value than they are in the traditional E-minis. So keep that in mind. Okay, so what if micro futures aren't for you? You don't want to trade for pennies when you can go for the big bucks, but you ain't got the big bucks. The best option for you, my deliciously greedy trader, and the option I have chosen for myself, is to take a funded trader challenge. There are a handful of companies that offer these challenges, but my personal favorite is Earn to Trade, and I'll link to that below in the video description. They constantly offer discount codes, so keep a lookout for those as they offer them on their website. So why do I like funded trader challenges? Because they allow you to trade big with a small investment. For example, I can pay $150 to take the challenge with an account drawdown of $2,000. That means that if I take the challenge and lose, I only lose $150. But if I was trading real money, I would have lost $2,000. Do you see the math here? It's a no-brainer. So what's the downside? Well, let's talk about what happens if you win a challenge. If I took that same $150 challenge and won, I would have had to hit a $3,000 profit target. The obvious downside being, I've only won paper money at this point. But at least I've now earned their real money funded account, and any more profit I make going forward will be real. There are more downsides to these challenges, and the one I hear the most complaint about is the rules. These challenges lay out a set of strict rules that must be followed. For example, you can't trade big news, you can't trade overnight, you can only trade a designated number of contracts, and you can't, obviously, lose more money than the challenge specifies, which includes daily loss limits. For some traders, these rules are too strict, but I ask you, did you really think you would get a shot at trading someone else's money with no rules attached? Furthermore, did you really think you could become a successful trader without the ability to follow a set of strict rules? Please. So remember, if you go the funded challenge route, read the rules carefully, follow them diligently, and make yourself a more disciplined trader. All right, we're about to get to the good stuff, the best strategy that you can use to day trade a small account. But first, let me give you one more reminder to punch that like button. All right, boys, here we go. Hello traders, we're about to get right into it, but first, there may be some of you out there wondering why I didn't mention Forex as a good option for small account traders, and indeed it is very popular for small account traders. But there are two main reasons why I don't recommend Forex, and the first of which we already spoke about, and that's micro futures. So micro futures have really taken away one of the main benefits of Forex. Would be that you could trade really small values, right? We were talking about the traditional E-mini S&P was a $12.50 tick value, $50 per point. Well, you could trade a fraction of that in Forex, and now that's available in the futures, the micro futures E-mini. So that eliminates probably the biggest advantage of Forex, other than the fact that you can trade 24 hours a day a little bit easier, like if you're in Japan or some other country that's not on the same time zone as when the market is open in the US. But the other major reason that I don't mention Forex, other than the fact that Forex is also known for some shady business practices, scams, things like that. I mean, if you don't know what I'm talking about, just Google it. You'll find it out real quick. But the biggest reason is they don't provide an open view of volume. Okay, so Forex isn't in on any kind of centralized exchange. Futures is on a centralized exchange. Any information that goes through that exchange, every trader has that available, right? We can all see the volume. We can see where trades happened. We can see where trades literally were executed, where trades were waiting in the book. You can't see any of that in Forex. You can't see the amount of volume that was traded. You can't see where traders are waiting to make big plays. You can't see any of that. And part of that is because it's not centralized. It takes place over a number of different platforms. Different banks are offering, their services to get you to go through them for Forex. And they give the information to the big players, but they don't give the information to you, okay? And that puts you at a severe disadvantage, and it also eliminates the ability to use my favorite strategy right here for a small account, and that is to play volume profile. All right, now the reason why we use volume profile is because it gives you a nice view of where big players are likely to jump in, and I'm going to show you that we had a great view of that just today on gold. All right, so if we go down to the chart, and we'll start speeding this chart up. This is a playback, but you can see this bar of volume right here, clear as day. You can't miss it. I call this a volume shelf, is kind of what I call it. It looks like a little shelf, and you can't miss it. That in this 147.80 area is where all the volume took place. And so what you need to do is wait for it to return to that area and make your play. All right, now you don't necessarily know if it's going to go up or down. You should have some strategy letting you know if you're planning on playing it short or long. And I'll tell you that when I use this strategy, I hit about 50%, maybe even less, but my winners are always bigger than my losers. And the reason for that is that I'm playing in the areas of interest, the areas that have been previously of interest to big players, and hopefully they will be of interest again, which means the market will move, right? So if you lose, you lose. You can't stop that in futures. You're going to lose. But if you win, hopefully the market's moving enough that you win big and make up for those losses. So let's just get into this. It's very simple. I've made videos about this in the past, but we'll speed this up, hopefully not too quickly, so you can see exactly what happens. We'll try to make this reasonable. But what you're going to see is you're going to see price come up, and it's going to hit this shelf, and then it's going to crash, okay? And then later it's going to come back up, and it's going to get very close to that shelf again, and it's going to crash again. And then it's going to break through, and then it's going to come back, retest it, and then it's going to go long, all right? So this level, this obvious level you could have played pretty much all day long in gold and been fine. So here's, I believe this is the, 620. So this is when it first happened. You can clearly see that it came up to that exact level, rejected off it on this bar. It tries a couple more times, and then you'll see it move down. So let's speed this up quite a bit. Rejects off that level. And there you go. A nice easy short. And it moves quite a distance for you, okay? I mean, that's a long way. That's multiple points in your pocket where you didn't have to risk much. Like, you know, if it starts moving up through here that level didn't hold, right? So that's how you protect your stops, to make shorter stops but bigger winners. All right, so we'll see that play out again. I think it plays out closer to maybe 720, maybe 740, but it starts working its way back up to that volume. And then it doesn't quite get there, so it's possible that, I mean, it's very close. That was within, on a day with price moving this much, that was within 5 ticks, you know, and you're talking easy 30 tick moves, 60 tick moves, okay? But basically retraces to that level, rejects off again, all right? I like to see it, you know, actually hit the level, but like I said, on days that are this volatile, in this market, you know, you take what you get. And so then the next one takes place maybe around 9:30. But I mean, you see how big of a move you're making off both of those? Big move, big move. You knew where to wait in advance. That's a big deal. You're not watching bar by bar and getting sucked into some kind of trap play. You're waiting in advance. You're stalking it. That's the best way. Trust me. The best way to trade is to have a trade stalked out and be disciplined enough. And the discipline part, that's a hard part, right? All right. So stick with me here, folks, because we're going to get to the good stuff here shortly. And you'll see, you know, below that shelf that there's a lot of noise in here. Like, there's not a lot to see, with one exception, and that is this kind of blank area here where the volume is exceptionally low. And I don't think it's any coincidence that that's why it kind of did this small retracement and then continued on down. And then we'll see, I think, coincidentally, that's also the same low volume area where, as it's starting to track up, small pullback, and then continues on up right to that zone. So, you know, it's not just the big volume zones, sometimes it's the dead volume zones. And so here we go. We've broke through. Didn't give you any resistance there, so you hopefully weren't playing that. But if you were, you'd already had 2 major winners in your pocket, so you can afford a small loss. Breaks through, it's in kind of this smaller volume area, comes back, bounces right off your big volume area once again, and continues on up. And actually, I don't remember if it gets through this other big volume area or not. That would have been a great place for a first target, just in case it rejects price, but as you can see, price broke through that pretty easily. So there you have it. That's how you play volume profile on a very basic nutshell level. I hope you enjoyed that, folks. If you made it this far in the video, that means hopefully you learned something. Pay it back here, subscribe. I need your help. See you on the other side, guys.